All right, so I just came back from a very long TDY. It's been a very long year, starting from last year with the shutdown, the fiscal year. It's been crazy. So I went to the brigade and battalion commander briefings, trainings, whatever those were, and I had a lot of questions. One of the questions was, can you put a IRA into a trust? The answer is no. You can't put an IRA into a trust. An IRA is an individual retirement account. Trust can't retire one, and they're for you, the individual. They can't be given to anybody else. But you can make the trust a beneficiary, uh, which instead of having your wife be the beneficiary, you have the trust be a beneficiary. But that's bad. You should draw down your 401k, your TSP, your IRAs, and you should use that money and then squirrel away your other money. And then they ask why that doesn't make any sense. And I said stepped up cost basis is why it makes sense. So I found this article. It's pretty good. It's by Quicken Loans, and it's by Victoria Araj. I believe that's how you pronounce it. Here's basically a quick explanation of stepped up cost basis. This is using a property. Family buys a property for 50,000. Let's say this is in 1990. Property appreciates to 150. Property is passed on after somebody dies. And now it shows that it's worth 150 and it was bought at 150. Now, why does that matter? Well, it matters because if you were to sell it, then the IRS does not see the 50,000 that it was worth initially. They see that it's you got it for 150 and you sold it at 150. No tax. If you got it at 50 and sold it at 150, that's $100,000 that has to be taxed. That's a huge difference. So if it's in your 401k, let's say you could do this with stocks as well, mutual funds, anything like that. Let's say this was in your 401k. 401ks don't pass on assets. Well, they don't pass on the asset. It passes on cash. So let's say you got your 401k and you're invested in all these stocks. Then what ends up happening is when somebody passes, they liquidate everything and they hand your beneficiary a check. Now that check is cash, obviously, and it goes on to your federal tax. Now it could either go, if it's in the estate, it could go to the estate and then the estate could pay tax, or if there's a beneficiary, go straight to that beneficiary. That money in the last, let's say in the last example, that 100,000 is stacked on top of the beneficiary's taxable income, making it, let's say they made 120,000 that year. Now they made 220,000 subject to the higher tax bracket, and it'd be a one-time hit, which is crazy. Now, let's talk about stepped up cost basis. And let's look at Berkshire Hathaway A. The reason I look at Berkshire Hathaway A is because it's never had a split, it's never been bought, it's never been turned over, anything like that. It's just pure, all the way from the beginning. So IRAs, 401ks came out in about 1974. So this is close. So let's say in 1980, grandma bought a bunch of shares. Let's say she bought one share at 300 bucks. Okay? She bought one share, Berkshire Hathaway, 300 bucks. And she left that in her regular brokerage account, fully taxable brokerage account, but she never sold. So all the way like this, she's got her one share, she doesn't know what it's doing. Hit 800,000 right here, and she passes. Okay? You get a stepped up cost basis, means the day she passed, that's the where they mark the price of the stock. So that means you got it at 800,000, and let's say you immediately sold it 800,000, there's no taxable liability there because you got the stock and you automatically sold it, and you didn't actually receive it until she passed. So that's not a taxable event. Okay? No stepped up, that's a fully stepped up cost basis. Okay? Now let's say this was in an IRA. Bought it for $300. IRA is now worth 800,000. She passes. The IRA custodian has to sell that stock, give you a check for $800,000, and that is taxable at your income rate, which could be, now it's 800,000. You have to pay the max 37.9% on that, on top of what you got to pay that on your income as well. So that is a nightmare scenario. You have one that's in the brokerage account and you get it no tax, and then the other is uh, you get the cash and that's taxed at your current rate because she never paid taxes on it, but she also never sold it. So you want to pass on stock, or you want to pass on an asset like a house. That way they get the stepped up cost basis. Now on top of that, let's say you just added this to your portfolio and you just transferred that Berkshire Hathaway stock into your portfolio. And now you have 800,000 in Berkshire Hathaway stock. Now let's say you sell it and you diversify into other stuff. Now you have a $800,000 in your brokerage account boost that wasn't taxed. And that entire portfolio can get transferred to the next generation at their stepped up cost basis. And that's how you create generational wealth.